Welcome back to the agreements class. I'm going to start by talking about the exam that you're all anticipating. So, because I realize that soon the summer vacations will begin and you have to make preparations. Some will stay here during the summer, some may head out, some are from overseas. They may want to go visit the family during the summer and make airline reservations, and some may just sleep through the whole summer session. I don't know what your plans are. So in consideration of what you might be thinking, I thought it's only fair to you that I let you know or announce when will that exam take place. One and only exam that I have in mind, which will carry all the grade, all the 100% of the grade, okay? Having said that, the exam will be held on April the 29th, which is a Friday. But do remember, please, very important, after the exam on the 29th, there will yet be another petroleum agreements class after that, which will be, April 29th, I believe it is. So don't think that the exam you've given does not mean that there's no exam. No, there will be no class after that exam. No, there will be a class. I want to emphasize that, please. So on the 29th of April, there will be a class like the class I've given throughout the semester, while the exam will be on the 28th. It'll be a 3-hour. Don't worry about the exam, please. It's the easiest thing you'll ever take or do. How do I know that? And very simply, give me a second. I think I hear a noise in the back. Well, please excuse me. I'm back again. How do I know that is the easiest thing you ever did? Because while you're allowed or will be allowed 3 hours, or if you need a little extra time, would be not a problem, that many students in the class from the previous years that I've taught this course, many years, that maybe half the class finished the exam in half the time. They finished in 1.5 hours and they're ready to go home and they can leave. That's if they're in person. Same thing goes with them. Online, that I wouldn't be surprised that if you don't finish, many of you will finish in half the time. It is very rare that there will be students stating till the end of the exam at 6 o'clock. The exam will be from 3 p.m. to 6 p.m. That's the class timing we know on the 29th of Friday. That does not mean you're rushed for time. To be finishing it as fast as you can. Take your time. I'll be here available to you, and you can reach me. And there'll be by a telephone. You can send me an email. I'll be available, and so will the TA be available. You know, John, he'll be there, and all this information about how you can reach us, it will be attached as instructions to you with the questions and questionnaire, the exam questions. Okay, so don't worry about it. Everything will be very clear to you with just simple instructions, nothing fancy. And we have done it twice before. Last year and the year before, we had the same situation, and everything went very well. There was not a question about anything that came up that was not responded to you by us satisfactorily. But I don't know if there was any question. There might have been one or two, I don't remember, but that was easily taken care of. And after you've given the exam on the computer, of course, internet, send a copy, email a copy of that exam to me directly. Number one, I'll be printing it. As you're sending it, my printer will be on and I'll be printing it almost simultaneously. Send another copy of the exam. One comes directly to John, the TA. So there'll be 2 persons. I will be receiving and so will he be receiving. And the third is keep a copy of the exam for yourself. We do that always because it is possible that through this internet business, maybe the exam was never sent to me or didn't come through on the internet. So if you have a copy yourself, you can send it again. Okay, so that's a precaution. So do keep one for yourself. What else can I say about the exam other than I'm looking at who gets the copy. Yeah, the instructions will be identical to what I gave last year with the exam, so there's nothing new. And they will accompany the questionnaire, the exam questionnaire. And there were 0 problems in the last 2 years, and I'm reading off the notes, and don't worry too much. And do one more thing, please. Don't forget, please, to write your name. That has been a case where students send the exam in, and they don't even write their name, and how in the world am I going to grade you? Plus, there's another thing I want you to put down on the in the exam response, the exams answers, is whether you're registered as a EER 396, PGE 383, or PG 363, okay? That will help me identify in which group do you belong. It really doesn't matter as far as grading is concerned. It just a little help to the instructor, me. And just a little bit. And so it will not affect the grading whether you're EER or undergraduate or graduate student. It would not make any difference, okay? The only thing I want to emphasize now is this is a closed book exam. And that means you cannot look at the tapes that you've been seeing throughout the semester. That also means you will not be looking at the emails or the notes that you'll be taking during the semester. I expect you to be honest and trustworthy, and be honest to yourself, not to me. I'm not the important guy. You are important for yourself. Let me emphasize that point. If I cannot trust that graduate students, undergraduate, UT students who advance themselves to this level of education, if I cannot trust you folks, who in the world will I trust them? So it's an honor system, you can say. So if let's take an extreme case. I don't think it'll happen. Let's say you look up the old lecture when I'm told don't look up the old lectures. Just give it to what you remember, and you look it up and you give me the exam, and then I say, oh, good, and I give you a grade. I may not know all the ways I can find out if you cheated and looked at the old lecture. What if I don't ever find out? Doesn't matter. Whether I find out that you're cheating in the exam and open the book and notes, it's really young men and young women, they do not matter. Believe me, I'm going to be out of your life in another 2-3 weeks. What matters is, take it from the old man. You have to live with it yourself. As long as you live, you will know, and you will know, and you will know. Of course, you're going to go, even when you're my age, an old man, that you'll know, well, I got through that exam, I cheated. You have the first rule of getting respect, young man and young lady, the first rule you have from somebody else. Why in the world would somebody else respect you or me unless I respect myself and unless you respect yourself? But if you know that you're cheating in the exam, are you going to respect yourself? You may have fooled me, but you don't fool yourself, please. Do not fool yourself. I'm not important. You're important to yourself. So when you respect yourself, don't cheat, don't do things I'm telling you don't do, then you're deserving of my respect also, or everybody's respect who knows you. Remember that. These things are important in life. That's what education does to us, besides learning how to what a PSA and a concession. Those are secondary things. Believe me, that you may never need those things. Who knows if you'll ever need those things. But this thing that I'm lecturing now about trust and trusting yourself to get a respect. Life without respect has no meaning to me. If I'm not respected, I don't even, I've got lots of things I talk about. I've told my wife that I said, there's only one thing I know is talk. But this time I know, you notice I couldn't even finish my sentence. If I can't trust myself, what kind of life am I leading? I rather not. Enough said. Take these kind of requests. I'm asking you as a request for your sake, not my sake. Yes, you said, Dr. Malik, you're a philosopher. Yes, I am. Maybe something, but I said may sink in, maybe, and I say, okay, we see what you're saying, Dr. Malik. I've done you a favor then. That way I've guided you. Let's stop here. And as I said, no problem. When on the April the 29th, when you see it'll show up on your computer, like these videos that you receive at exactly 3 o'clock. That's the class time, that's why. In the afternoon till 6, that's a 3-hour. And if you have any questions or you want to say, I could finish in 3 hours, I say, okay, don't worry, go and finish it. Okay. So now you know how to plan your summer, where you want to go, what to do. I think I've done my job now. Let us get back to the purpose of today's lecture. Why are we here? As a habit, I go back and touch on some of the things we talked about when we closed the lecture last time. And it was a very unusual lecture, I know that. You were not expecting what I started. You remember the 7 or 8 points I put on behind me? It's a good agreement. That's the subject is. Well, at the end, you learn what is a good agreement. I've not done it. I've just given you the concept that it should be flexible. It should move and move automatically. It should not be static, and all the good stuff, which should be dynamic. All those things that I wrote down. Slowly, you will begin to appreciate. Probably not at the end of today's lecture. This may flow into next lecture also, very likely. And by the end of next lecture, that's when all this mystery of what's the living agreement, what's the dead, and I hope you'll begin to appreciate what I'm saying. The reason I use is living and dead because this keeps a little interesting the lecture. Otherwise, the petroleum agreement could be a very dull lecture. Now you may all go to sleep. Having said that, then we went into, and then we said, well, the good agreement is one that has no economic distortion. Remember that, because I'm going to touch on all of these things. And where I gave you the example of an oil field. When I went to the manager of the field, he said it'll be 15 years life if you don't look at taxes, and if I look on the technical side, it's only a pressure, volume, temperature. But if you look at the add-on taxes to the life goes to $12 years, and therefore you have reduced life by 3 years, and that's a distortion that should not be the case. That's not a good agreement. None. Okay. And so I've explained that. And when will you have a good agreement? When will you have no distortion? When the agreement is sensitive to put on 3 things: the cost, operating cost, the size of the field, which is reflected in the production profile of the field, and the price of the commodity, here oil and gas. This was the summary of today. The lecture starting last time will flow today and next time. That was the summary. I realize you don't follow what I'm saying. I understand, because I've not explained anything to you. What I've just told you is the end of the part 3 of this 4-part semester course. Okay. So don't worry if you don't understand, because I've not explained it. That's the end. Now, we start with the lecture from last time. This is important because today's lecture has to be a kind of a continuation in thought process from where we left off last time. So I'll have to go back a little bit in the past lecture so that I can connect with today's lecture, which I'm doing now, and I'll continue. And I said, well, how do governments collect revenue? And I cited 2 ways: they take it or you give it. Take it is the taxes. You don't have a choice. the government will put you in jail, you don't pay them. I hope you don't end up there. And if you do, don't call me. I'm not answering my call from anybody going to jail, okay? And number two, the companies give it, okay? And that will be, there is attachment last time with this lecture, and this time, again, I'll put the same attachment. When it would give it like through the auction process, it's attachment A. We're going to have the same 3 attachments in this lecture, just in case you don't have it from last time. And attachments A says OCS sale 166. That is offshore. OCS outer continental shelf. If you don't like the word sale, it's auction 166. Okay, we call it sale, but really it is the 166th auction. Maybe the Department of the Interior has been auctioning the offshore lease blocks for the last maybe 50 years, and this happens to be the example of the auction number 166, where Shell gave a bid of $71 million, and then there was Chevron and Conoco and Texaco, and this is quite a long time back. And that this, I've copied this from, doesn't matter, the concept is the same. At the bottom, it says more than $500 million. That sale alone, the government received $500 million. To benefit the government, no risk. They didn't find all, the government got the money. They lost the money, the company. Money today is better than money tomorrow. Buying more today than what you can buy for the same amount of money tomorrow. So, no risk. The disadvantage is not many companies have spare $100 million, $50, $70 million to just try it and see. Maybe there's not. Very few can afford that kind of risk. So you limit the number of bidders, and for a good bidding, you need more bidders. So they keep on increasing the price of the bids. So that's all I did last time, which I think you understand by now. The second one was the royalty bidding, right? This is called, what I just explained to call is cash bonus bidding, that you give the government cash up front. So if you want more bidders, you don't ask for cash up front. You ask, the other kind of bidding I'm going to talk about today, which is royalty bidding. And I gave the example here on the board about royalty bidding, because my left and the right, you can look at it this wherever you are, okay? And I forget which company. One company, I think, was 20% royalty was the highest, and I said, well, give it to those guys. No. Everybody in the world I've lectured, oh yeah, give it to the guy giving it so much royalty, 20%. It's so easy to answer. And I said, no, you will not. I will not. That's something where stuns, S-T-U-N-S, stuns people when they hear that I will not. And you should be stunned also. And I said, to understand why I will not, then expect you to look at attachment B. Attachment B. What is attachment B? And I allot some time for you in the class. Look at it. And I said, well, have your questions. You're bound to have questions. And then I said, I will cover them one at a time. So put that attachment B in front of you. And it says on the top, what does it say on the top is reserve and economic evaluation, or economics, same thing. And I've been using this since January 1, 1988, as you can see. Okay. That's got 24 quarter of a century back. Nothing has changed. This is a real case, okay? So let's not waste time about getting to the point. Let's get to the point. And on the top of this, you see, on the left side, there's the year, of course. End of year, 1 year in 1980, well, the year 88, year 89, so on, I don't know. A column. Column A is gross production. Gross production. Gross means total oil and gas production. Place yourself on the table. Gross oil and gas, because it has gas production with this oil production in this well. If you don't know what is gross, that means total. Sometimes technical people who are thinking and the reservoir and water flooding and water cutoff and all that. No, this gross production has nothing to do with water here. This is the amount of oil and gas that will be produced. Forget about the water part of it. Okay? Because sometimes they say, oh, what about the water? I thought gross. No. That's the amount of, like 13,000 barrels of oil will be produced in 88. The M barrel, BBL, M in the oil business is referring to thousands. So when you say oil, MBBL is 13,000 barrels and 13 million cubic feet. How do I know million? Because 1 M is 1,000. There's MCF, 2 M is a million. Okay, million is 2 M, 6 zeros. And net production is after taking out a royalty of 25%. You can do the arithmetic, you'll see it. It's an Excel program. You should be able to do that arithmetic. So that is B column is 75% of A column. Let's move on to C. In case of C, it is a price forecast. Everything is a forecast. The production is a forecast. From when? From January 188. The price is a forecast. That's it. Everything is in the future. We don't know it's right or wrong. That's a forecast. The production forecast, you can go for the reservoir engineer and he will give you the answer. Price forecast, you can go to the economist of the company, or the corporate planning people, they'll give you their forecast. This is what is $17 a barrel in 1988. Moving on, the next column is D. D as in David, the revenues, as you can read. Simple, it's so simple, it's arithmetic. D is a multiple of net production and oil price. Do it yourself, you'll find that's the answer is $181,000. Okay. Is it 1,000? Yeah, 1,000. That is net. No. That is revenues. Very important. Focus on column D, we'll come back to it. That's revenues. D, revenues. And we'll go all the way down to where it says the year 1999. The revenues have dropped down to $35,000. Revenue is a plus. So revenues are going down from 181,000 the year 88 to 172, 163, 154, all the way down to 35,000. Let's talk about the next one. E column. It says operations, SEV, ADV, WF, taxes. Please remember, you want to know what is it? No, don't worry about it. I'll explain it. These are terms that SEV stands for severance. Don't just hear it, just say SEV, because I'm going to make it easy. ADV stands for ad valorem. WF stands for windfall profit tax. Cut out SEV, ADV, cut it out and just write on local tax. Local means to the government of Texas. So all these fancy terms, ACV, SEV, ADV, cut it out. Just write on tax to the government of Texas. Local meaning the state of Texas. Because I said to you earlier, between A and B product column, gross and net, I said there's a royalty, okay? and that's 25%. That goes to the government of America or the landowner. This tax is going to go to the government of Texas, okay? I hope that's clear. So I'm talking to you. In other words, this is the splitting between government and the federal government and the state government. Because in Texas, we do have a local state of Texas tax on the production. The next column is column F. We're getting to the end. Operating expenditures. What does it cost to run this operation? The cost. Sometimes we call it just Opex. So you see, in the year 1888, it was $53,000, started dropping down to $31,000. You can see yourself, this operating cost is a minus, taking it out. Next column, I'm getting to the end, is column G. You see that G column? It's a capital cost. Sometimes it's just called CapEx, capital cost, or capital expenditures, CapEx. Operating expenditures, sometimes called Opex, just to abbreviate it. You might notice that capital cost is shown as the cost of drilling the well. It's shown as zero right from year 88. And if you're wondering, sir, why is it zero? I'll tell you why. Because I went to the local consulting company, I think I told you, and I took this particular evaluation that you're looking at, attachment B, from them. It so happens that they gave me this evaluation, from the real well. And I took it home and I said, okay, now I'm going to make a photocopy, which is in front of you. This well was not drilled in 1988, it was drilled in 1983. So 1983, the capital cost was whatever it was, not important to us at this time. But this evaluation is performed in 1988. Therefore, in 1988, you can see there will be no capital cost because the well was drilled 5 years earlier. Last column, forget the I part, H. As far as we are concerned, we go to H and not to I. I is not necessary in this case at this time. H columns is cash flow, B tax, before tax. B is before. You say, sir, what about taxes? You've been talking about taxes and all that, but what about this before tax? Yes, I'm right. Yes, I was talking about taxes, but what kind of taxes before is this? Which one? This is corporate tax, and corporate tax is based only on the profits. And we're going to talk about that after I finish today. That's now. We're going to talk about it. So this is before corporate tax. Royalty is paid, you can call it production tax, the moment you produce. Corporate tax is paid when you have a profit. You don't pay any corporate tax if you don't have a profit. Okay? So I've explained to you all of these columns very slowly. At the bottom, you might have noticed there is WI fraction 1.000. WI stands for working interest. Don't worry about the fraction. That means, in this case, the working interest of the company was 100%. They were going to pay all the cost. I've explained working interest before. Net oil fraction is 75%. That means NRI. I don't know what they call it, net oil fraction. It's really the correct terminology is NRI, net revenue interest is 75. So the company spends all the costs and then they get only 75% of the revenue, and the remaining 25% go to the government, okay, as royalty. I hope that is clear. Before I get to the next important part, why would I not give to the highest bidder this project is coming now, slowly. Okay. Let all that I've said, A, B, C, D, all the way to H sink in, please. Go over this again, please, in your own mind. I give you 4 or 5 minutes to 3, 4, 5 minutes. I'll just sit here and we'll just sit like this. I want you to refresh yourself what I've just said, because that is very critical at this time. Just take your time, go through this from left to right, A all the way to H. See if everything is clear the way I've explained it. Because very soon you're going to get an answer yourself. Why would I not give royalty to the project to the highest bidder on royalty of that 20%, I think it was. Well, yeah, 20% in that last example I gave last time. Now I'm going to ask you some questions, please. Typically, if you were sitting in front of me, I will ask you, and then you'll respond, and I'll write it down. Here, I'll ask you, but I can't hear you what you're saying, but so I'll also tell you what the answer is. There, I would ask you and then correct you and tell you what the answer is. But here, you can't answer it in the way this online thing works. I'll just tell you the answer, and you'll follow what I'm saying. It's not difficult now. Question. Look at this cash flow in front of you now, in attachment B. Let's look at it. The question I'm asking each one of you individually is, if you look at it, the cash flow, in which year did the well stop producing? Which year? Just look at it. When did it stop producing? It's right there, you're looking at it. Let me give you the answer. Look at it. The well stopped producing in the year, what? 1999. You can look up it, up there, right here. I think yours has a yellow coloring also that year. It stopped producing in 1999. You can see there's no production after that. Not a difficult question, was it? Now the question is, why did the well stop producing in 1999? That's an important question. Think, please. This is all about you thinking now. I can give you the answer, which I will. But I want you to think. Wish I was in the class asking you why. Hear your voice. Some of you would say, well, because there was no more oil left there to produce. No, That may not be the correct answer. And other can come up with 10 different answers. Let me tell you the answer. The well stopped producing in 1999 because, write that down, it reached its economic life. Slow down, write it down. The well or field, whatever you want to consider it, stopped producing in 1999 because it reached its economic life. There could have been still more oil, but they can't produce, they will not produce more oil, not because there's no oil left, because it reached its economic life, also called economic limit. Same thing. That's the answer. Your question should be, what do you mean by economic life or economic limit, Dr. Malik? Very simple. And write it down. Economic life is, definition, when your positive cash flow, write it down, is equal to the negative cash flow. In the last year, write down the word in the last year, when your positive cash flow is equal to your negative cash flow in the last year. That is when we say the well has reached economic life or economic limit. So let me try to explain it again. If you look at the, what does it mean? That means, what is the positive cash flow? Your positive cash flow is equal to negative cash flow. That means what? Equal to. Positive cash flow are your revenue. They're coming into your pocket. Negative cash flow are your expenditures, which are going out of your pocket. When your positive cash flow is what? It's revenue. It's a plus coming into your pocket. Negative is expenditure, negative minus. So what I'm saying is, when your positive cash flow, that is a plus, are equal to your negative cash flow, that's a minus expenditures. When your revenues and expenditures are equal in the last year, you told the computer, you did, stop printing at that point. Again, I'll support. You said the computer is a program, you programmed it. When these two elements, the revenues and the expenditures are equal, stop printing, because economic life has arrived. So you did, computer is just listening to what you told it to do. I'll show it to you from this example number, attachment B. Look at column D. See column D? Year 1999, what is your, that's when it stopped producing, revenues are $35,000, the plus, you can see $35,000. Your local taxes, 2.7, that was $3,000. Your operating cost, 31.8, that is $32,000. That's negative. Your taxes are negative. So you take your $32,000 from column F at the bottom of 99, and the $3,000 from column E, and add up the two, that is $35,000, which is your minus. And if you column to column D, the revenues are 35,000 share. The revenues are equal to the positive are equal to your 35,000 negative in E and F together. Computer said, stop it. No more printing because the two are equal. Very straightforward. Now I'm going to give you a good 10 minutes maybe. This time I allow students to mingle also, talk to each other, but you're sitting alone, I guess. If you're sitting together, to consult your fellow student with you. You need a little extra time now. From this reserve evaluation that you have attachment, look at it. After hearing what is economic, my question is, there lies the answer. I'm coming to give you the answer very soon. You're going to be surprised. My question is now, can the economic life of the well change? First, I'll let you think, and then we'll go into details. So let me give you maybe not now 10, but 5 minutes. I can give you 10, but why waste your time? The answer can be only yes or no. Can the, or maybe not, maybe yes. Can the economic life of the well, or this well, can it change? If you gave the answer, yes, the economic life of the well change, that is the correct answer. Yes, it can change. That leads me to the next question. What is the next question now? This is where I'll give you 10 minutes. I'm going to note the time because you need to go and look at this more. Look at the attachment B. The question now is, if you said yes, it can change, how many factors can change the life of this well or this field? How many? It's a number, 2, 4, 6, 10, 100, whatever. You have to come up with that. And I'll ask you how many. How many factors, by looking at it, you should be able to tell me. 90% students tell me what they are. So I'm encouraging you. It's not a difficult question. It's common sense, basic common sense. Then we'll talk, what are those factors? First, say how many, give me a number. Look at it, study it. Whatever you say, I'll discuss it. And then we'll talk about it collectively from my lecture. And then we'll write down what are they. Okay? And at the end, you will get the answer yourself. What we're looking for is what happens when royalty is very high. That's what we're trying to understand. Okay? So count. Take your 10 minutes. Think carefully and count. And I shall be here, sitting here in 10 minutes. Don't be late now. Good. Okay, I'm back. I hope you're back too. Well, it's exactly 10 minutes. So before I left, we took the break. No, I took the break. You did not. You were working during the break. This is no break for you. And that we talked about that how many factors would affect the life of the well. And first we did establish, yes, it can change life, economic life, but how many factors? Again, I wish I was in the class. I would ask everybody to kind of respond collectively. We learn from each other since we're not in the class in that forum. So I'll just have to list those factors myself, okay? Let me write down one at a time. What are the factors, okay? Factors that would influence the economic life of the well. And I hope you will agree. I'll write it for you. Number one. And we're only going to focus at the end of the project life, year 1999 in this case. Let's say oil price. Question. If toward the end of project life in 1999, 1998, toward the end, if the price goes up, oil price goes up, what will happen if the price goes up to the economic life of the well? The price goes up. That means the revenues will go up, of course. Okay. That means what? You will continue to produce. That means the life will go up. Number one. Oil price or gas price. This go up toward the end of toward the end, somewhere 2-3 years before the end. The life of this project will go up. Number two. Let us say toward the end of the project, while you're producing from this oil field, and the oil field, let us assume, not a good way to show an oil field. Let us say the oil field is generally going like this. Let us say this is the production profile of the field. Let us assume that going steeply down. And let us say if you add technology, okay, you add technology to it. If you don't add technology, it'll follow the path A. It'll go down profile A. If you add technology at this stage, maybe water flooding or whatever, the profile will go like this, like B. Therefore, the life of the well will go up. So because of technical factors, if you add technology to it, the production profile will go up. So the size of the field, production. Which is a function of the size of the field, production based on technology. If the size of the field goes up or the production goes up to this trajectory because you've added technology, the life will go up because your production will not go down very rapidly, so you'll have a longer life. Number 3. Opex. Operating cost. If the operating cost go down toward the end, go down, you got less expenditures. The revenue will, the field will go, life will go up. Obviously, there'll be less expenditure, so you'll keep producing. Life will go up. Number 4. Now, royalty. Same thing. If the royalty to the government goes down, what will you do then? You'll continue to produce. You're paying less to the government. There's no reason for you to quit. So you'll continue to produce because the royalty went down, the taxes went down, production tax. So the life will go up. The life will go up. With royalty going down, the life will go up. Toward the end, or so how many factors have we concluded? Are 4. Okay. There are 4 factors that govern the life of the field. It's oil price, size of the field, which will affect the production, which can be affected by the technology if necessary. The life will go up if you add new technology. Opex, if they go down at the end, the life will go up. And here royalty, the life will go up if the royalty goes down. Now what happens? You can kill the field life by adding high royalty. So this, any field, which would normally have a life of 12 years, at a certain royalty, if you increase the royalty, you're paying the government more, the company leave very quickly. So, well, all we're doing is paying the government extra royalty. We're not going to stay here. We'll just stay here for 7 years and leave. Because the government is getting royalty, we're not. So the life of the field went down because the royalty went up. What did I say? Royalty went down, the life. So the royalty can have a major impact on the life of the field. I'll give some examples. And this question came up the other day from somebody. Why do companies do this and do this? And you say that's wrong. Sometimes they do. Same here. You probably made the same mistake. So give it to the guy, the project, the company, which is giving government the high royalty. And I said, no, you're going to give high royalty. You're going to kill the project. The government is going to be a loser. But they think they're making a lot of money because the royalties are counterproductive. And I'll give you an example. Once I had a large delegation in April, which people from around the world, literally in every April for 20 years till recently, I would have people come from around the world to listen to my lecture, this one and many others, for 3 weeks, 8 hours a day, 3 weeks. They stayed in the Arboretum area, if you know where that is, in a hotel called Renaissance Hotel. It's the name. I think it's still called Renaissance. And there was a delegation of 12 very senior managers of the National Oil Company of India called ONGC. The group general is the highest guy over there in the company. And every word I said for 8 weeks, every single word, he wrote down on his notes, every word I said. He's the chairman. When I talked about this, that the high royalty can kill the project, I still remember I still remember the chairman, he's put his hand on his head. I asked him, I said, what happened, Mr. Chairman? He said, in India, we did not know this. We were increasing the royalty at the end instead of decreasing it. I'm going to give you an example. We were increasing it, and therefore what happened? Nobody came there to look for oil because they were doing just the opposite of what I'm saying. So the best thing is government that are learning slowly, very slowly, are doing what? Towards the end of the project life, they are decreasing the royalty. So the government takes less, the company keeps more, and the company continues to stay. Government will benefit also. I'll give you the reason in a minute. So the company will stay there longer because the government is taking less. That means called sliding scale. Sliding, you know the word sliding scale? S-L-I-D-I-N-G. Sliding scale royalty. It's a policy question. It's not a technical question. This is decided by the parliament, by the Duma if you're from Russia, by the Knesset if you are from Israel, by the parliament if you're in UK, or the Congress legislation. So what happened? Government that are smart and learning, not everybody does it, slowly. Toward the end of the project life, they are decreasing the royalty. So the company will stay longer. Now, even by decreasing the royalty, what the benefit to the government, maybe they will not get enough revenue from royalty, but the company will stay longer and they will have a profit. Profit is on profit. They only stay in the country if there is a profit. And then instead of paying royalty as production tax to the government can get what? Profits tax through corporate taxes. No problem. The government gets on the back end, the tax. If the company stays longer in that country because the royalty has gone down now, who are they going to employ? People from the local people, the domestic trained people. And they're going to employ the local domestic market people from the local engineers. They improve the employment. So they get corporate tax, improve the employment. So much so, the government of China realized, wow, we should also introduce legislation where they reduce the royalty toward the end. And they did. So in China, what did they do? They brought down the royalty all the way to zero. They brought down the royalty all the way to zero toward the end. Somebody said, that's foolish. No, it's not foolishness. Smart. That means federal government gets less money as royalty production tax based on production. The company that's long as possible, long they stay there. Then again, company will make profit and give the government profits tax, corporate taxes, and also hire the local people from China to employ them. So you see, this is what happened. Get of India, instead of lowering the royalty or keeping, this went up, and that's when the chairman, put his hand on his head. And then he comes to me, he said, well, Dr. Malik, we want to invite you. I said, where? To India. I said, what for? He said, well, if I go back, chairman, no, they'll listen to me. The Congress is political people. Maybe if you come there and you talk to them, the Congress committees on this matter, maybe they'll listen to you. It doesn't happen like one person, Christian Malik, is going to go there and the whole world is going to shake. No, to take legislation could take a decade or 10 years, but at least my job is to what? Plant an idea. Plant an idea. That's what I do. Okay. Give an idea. Let's do that. Let's do that. So Early on, the introduction of this course, I said, a good agreement is what I'm going to teach, what I've just taught you. If you look at your notes, notes, what you will see, I think it's the first and the second lecture. Yeah, it should be in your lecture, Has to be. I said that I'm going to teach you that here is a project. Company gets 10%, government gets 90% of the project revenues. And then I said, I'm going to teach you how to take this project, same project, and make it into and I said, I'll teach you to make this same project from this, where the company gets 10%, government gets 90%, into this much bigger, huge. Company still gets 10, government gets 90. But again, look at the size of this 10. Look at the size of this 10. Boy, here the company is making maybe $5, here the company is making $500. The percentage don't matter, it's the amount, 5 versus 500. So what have I done? I didn't bring in any technology here, did I? Only legislation. Only legislation, folks. Nothing else. So that is what I'm trying to teach and get to you folks. Okay? That takes me to the end of government. Two things, collect revenue through bidding, royalty of cash bonus. Let me take this off. So where did we start? The third part of this course, the two ways the government get revenue through: auction bidding, discretionary, volunteering. The other one is compulsory, no choice, mandatory. The company have to pay, it's involuntary. We finished the bidding part, and the second part, how to collect revenue, is the taxes. So now we are introduced a new topic of taxes. But before that, let me introduce you to, give you an example. So I'm going to talk about taxes in a minute, okay? In connection with this, let me say this. All along in the last 20, 30 minutes, what I've preached is, okay, lower royalty can extend the life of the project. You say, well, I like what you said, we enjoyed what you said, looks good, but show us if it has been tried somewhere. Where did they try it? Where is the proof? proof is in front of you. To show you that it worked, what I've just preached you has worked, look up attachment C, please, for that. I'll give you 2 minutes to look at it, then I'll talk about it, and that's where it has worked by lowering royalties. Read it, I think it's in color, it should be in color. Give you 5 minutes maybe to read it, then I'll talk about it. Read it carefully. Look at the units on the left, number of tracks receiving bids. 1994, there's a sale of 150, auction number 150. 95, auction number 55, auction in 1996, auction number 161. Attachment C. What attachment C says on the top, and I'll read it to you, how royalty relief has influenced Gulf sale bidding. Royalty relief means taking less royalty, relieving the burden of royalty from the company, okay? And there are 4 different colors for 4 different auctions, 94, 95, 96. These are bar graphs. Gulf of Mexico, it actually happened. These are real cases. You don't have to read the whole thing. So the 4 graphs for each sale, but concentrate on 1995, and there is a water depth of less than 200 meters, 200 to 400 meters, and out of the 4 graphs, the maximum it goes to the water depth of 800 meters. So what you see here is that in the 1995 auction or sale, that's sale number 155, in the deep offshore areas of 800 meters or more, the government only received bids for how many? 74 tracks in the 800 meter or more. It says on the left side, the units are there. So the government only really got tracks 74 that got the bid. But 1994 and after, they got very low number of bids. The government realized, US government, wow, what's this, man? We have to do fine. We have to find new ways. We have to give more advance, more incentives to the company so that we have more tracks more companies will come and bid for more tracks. So after seeing what happened, the poor results in 1995, the government gave a relief of royalty to the company. Relief means lessen the royalty to the companies, and then opened up for more bids in 1996 after the government lowered the royalty. And you can see for yourself what happened after that. In 1996, sale 161, those same four graphs, and in depth of water of 800 meters or more, how many tracks were bid for? 321, folks. 321. 321. You can see yourself. So what happened? From 74 tracks in 1995, the government said, let's lower the royalty. Everybody and his friend came and bid up 321 tracks. What a jump. I don't know what percentage that jump is. What is it, 400% or something like 4 times more? Yeah, much more. So there is a perfectly good example of what I've been preaching about royalty relief, lowering the royalty. So it's just not a made up story by me. This actually did happen. I've proven my point, okay? Having said that, I think I should give you some relief myself. And how do I do it? And by talking now about taxes, the subject of bidding and all that thing, volunteer, all is over. Now we go back to the second way of collecting revenues with the government is through taxes. And before that, I'll give you maybe 10-minute break, 10. Because last time I cheated, I took the break, but you didn't because you were looking at attachment B and C, right? Yeah, B and C. So that break was not for you. I think that was unfair, but you were working. Now this will be a genuine break for you now. Meet me, let's say, 10 minutes. That we know. Then it's a totally new subject. Don't miss out on this one. It's taxes, because government gets revenue through bidding and auction and also through taxes. So I come back in 10 minutes and we'll talk about taxes until we go home today. Okay, thank you very much. Okay, I'm back. I hope you're back too. Now we're going to talk about taxes. Of course, you can get a bachelor's, a master's, a PhD in taxes and accounting. It's an accounting question. That's not the intent. I'm going to introduce you how companies get taxed, just an introduction. And it's going to be again a policy question. And how do taxes influence companies to go to this country or that country, this area or that area? Many factors influence that decision, but one of the factors is taxes. How much money the company thinks they will have left after paying the taxes to the government. That is a very, very important consideration. To make it very simple and understandable, I'm going to write down, just because of the pronunciation, it may not be clear, and spelling, a couple of 3 words, okay? Then I'll explain what they mean, because that is very important that you follow what those words mean. Okay. Subject is how much tax a company pays is a function of how God is. Of course, many things. You get a PhD in that. I'm going to reduce it to just simple thoughts. And how legally one can save for having to pay a lot of tax. Legally, morally, socially, in every way you can imagine, ethically. The first point is very obvious, you don't even have to write. How much less tax that a company or you and I will pay, number one, is on the tax rate. If the government says the tax rate is 20%, that means the government takes 20% of my tax money. If it's a company profits or taxes or income in individual cases, if there's a 30% is taxes, well, then I pay 30% of my income or the profits to the government as taxes. So that doesn't need explaining. What needs explaining for those who are not familiar with the terminology is depreciation method. Remember the word I'm using, depreciation, put it in your mind. And depreciation, allowance. And another way, third way, one is tax rate. Number 2 is depreciation method. Number 3 is the possibility of offsetting loss losses. I'm going to explain everything. For one, I think on the top one, depreciation allowance, how it influences the decision where to go. I will take you to America and to Indonesia, and to Norway, and for all loss offsetting, we'll go to Indonesia and the United States, because I promised to you that in this course, we could cover a lot of countries, okay? So let us talk about the amount of tax you pay besides the tax rate. Number one will be tax. Number two will be the type of method allowed. Write it down. The type, I'll spell it out here, then I'll explain. How much tax the company pays depends on the type of method. The government allows you to calculate your depreciation allowance. To calculate your depreciation allowance. So your question is, what do we mean by depreciation allowance? I'm going to explain that. And also the question is, what do you mean by the different depreciation methods that the government allows you to use to calculate your depreciation allowance? Take a little explaining, okay? And then after all that is done, then we'll talk about offsetting loss provisions or offsetting just losses, okay? Let's talk depreciation allowance. They help to reduce your taxes legally. And what is that? What is it when we say depreciation allowance? Well, just as a background is, a depreciation allowance is only calculated, and you'll understand when I finish, on tangible assets. Only for tangible assets, not intangible. Tangible will be the building, the car, anything that you touch and hold, physically, the table, the chair, these are tangible. So you can calculate the depreciation allowance based on the cost of the tangible assets. The table costs $500, so I can use that as a cost basis for calculating allowance. So what does that mean now? Slowly you'll understand the accounting part of this course. Let us say the income is, your company's income is $1,000. And I'll explain everything. You have calculated depreciation allowance of your car for that year. I'll just make a depreciation allowance. You write a depreciation allowance for the company car is $200. It's a company expenditure because you're using the car for company business. Represent allowance, right down. I can write the whole thing. One, it saves time if I don't. Two is sometimes it's not coming off, so it takes me a lot of time wasted. I'm just trying to remove that, and then I have to wait so this dries up, and I want to save time. So the total income is $100. Your depreciation allowance of tangible is car. Take it out of $100. And that means you get an allowance of $200. That means that from your total income of $1,000, you do not pay tax on $200. That is called a depreciation allowance. So you end up paying tax on how much? $800. Thus, you reduce your taxes. Instead of taxing $100, you're taxing on to paying tax on $800. So that is a good news. Okay. The question is, why do government allow the companies to reduce the taxes? Every country has that, every nation. They allow companies to reduce the taxes legally through what is called a depreciation allowance. This one way to reduce your taxes is through calculating the depreciation allowance. How do we calculate? I'm coming to that in a minute. Why is it that the government wants you to reduce the taxes? Because it is good for the people, the government. So how is it good for the government? They're reducing tax? Yes. Let me give you the philosophy of taxation. Let us say I have a computer that I'm using now. It cost me $2,000 to buy. And I'm using it for 5 years. And every year the government says, take your, what did I say with the price? $2,000 computer to cost, divided by 5, the answer is $400. That means the $400 is your depreciation allowance. Take the cost divided by the life of the computer. Each year you'll get an allowance of $400. That means you will not pay tax on $400, thus reducing your taxes from the total income of the company. And you say, well, why is it the government now is not taxing you on the $400? Answer is very simple. That is, after the government realizes that after 5 years, you may need another computer because this computer is getting old. So the government says, we will help you buy a new computer so you can pay taxes. So that you can reduce your taxes so that you have money saved up to buy a new computer so you stay in business. And I'll explain how. The government says, you're a smart person, so you're not paying taxes on $400 every year for 5 years. Maybe if you're very smart, you will have saved up $1,400 from not paying taxes. Normally you would pay taxes, but this way you're saving $1,400. You're not paying taxes because we asked you to reduce your tax every year by $400 thereabout. And we are hoping the government says that you're a smart businessman, that after 5 years or 4 years, when you need to change the computer to stay in business, you will have some money saved up, $1,400, and put some more of your own money and go buy a new computer in order to stay in business. So the government is allowing you to take the old computer, replace it with a new computer in order to stay in business and hire more people, and the business flourishes and we make a lot of money. So they're not saying don't, they're just deferring it. They say this, take this benefit, save the money from not paying taxes, keep adding it, hoping after 4 or 5 years, you would have saved enough money to buy maybe a new computer. Put a little bit of your own money, and then you have, and then you stay in business with benefit. So in order to replace the old equipment by the new equipment, the government gives you this allowance, permission. Allowance is a permission. Different governments around the world have different ways by how to calculate the depreciation allowance. Saving in this case, $200. Some government may say, use this method, you may save $250. The government say, no, use this method, you may save $300. So obviously, you're going to go to a government that helps you save more money in taxes and go to the government offering you $300 tax benefit. Obviously. So let me give you a little more details. Okay. Around the globe, there are essentially 5 different ways, 5, to calculate the depreciation allowance. Let me write them down. Straight line, and one method used around the world, most commonly used, is the straight line method. How could calculate? I'll show you later examples of how it's done. How to calculate the depreciation allowance. Okay, that's the most used. We have it in America also. Another method would be double declining balance method, DDB. Another method is called units of production method. A method that ACRS. ACRS. I'll give you the name in a minute in detail. Another method is These are straight line method, double declining, spelling. Decline, D-E-C-L-I-N, declining I-N-G. For example, you can abbreviate it as a DDB. Double declining balance method is used in Indonesia, for example. Number 3, these are just the names. I'm not going to go into mighty details. Maybe a couple of 2 maybe. I will. Number 1 and number 5, I'll compare. Units of production method. The 4th one is ACRS. If you want to know, I'll tell you what it means. It's a long one. You don't even have to write it down, but I'll tell you. ACRS is accelerated cost. Accelerated cost recovery system. I repeat, accelerated cost recovery system is method number 4. This was introduced in 1986 by President Ronald Reagan. And this is only used in America. The little background of this is, then when President Reagan wanted to be elected, he said, elect me. He said, why? He said, because I will reduce your taxes. We elected him because it sounded very nice. He's the only politician I can remember who kept his promise. So when he became president in 1986, no, he became president much earlier, but in 1986, he rewrote the entire tax code of America all over again. And he did reduce the taxes tremendously. You know what? How much? You will not believe it. Before he became president, the taxes that a rich person paid in America was 70% tax rate. That means the rich person who made $100, had a $100 income, he would only keep how much? $30. The government will get how much? $70. Is that fair? Of course not. Reagan said, no. That is not fair. I will never let that happen. So he rewrote, as I said, the new tax code. And guess what? Because of his new tax code, the maximum tax rate dropped from 70%. You know 70% I just said? Get ready. You will not believe your ears. From 70% tax rate for the rich, he dropped it to the maximum anybody will pay in America. It'll be 28%. Can you imagine? We love him. So instead of having $28 and $30 left in my pocket in the old tax system, now I've got how much? $72 left. Why would I not like him? We elected him twice, though. And people thought he was nuts. Why would he do that? Because we will have a tremendous deficit in our budget. And he proved everybody wrong. We not only in a deficit, after the next president, I think, was Clinton. After him, we had it was George Bush Sr. He proved everybody wrong. In subsequent years, after reducing that, we had a surplus in our budget. Can you imagine? By lowering the tax rate, I wish I had more time at my disposal to explain to you how that helped, including having a deficit, a loss in the budget. We have a surplus, a positive in the budget. Wow, what I imagine. Tell this to other people who keep talking about raising your taxes. I believe in paying taxes, but not the way they were taking away $72 of my hard-earned money. Yeah. So finally, there is that fund. The Accelerated Cost Recovery System was acronym ACRS. The first method to calculate depreciation, number 5, is sum of the year's digits. Sum of the year's digits. Write it down. Used in, I know we're going to talk about, I thought here we will come up with Norway's example. No, I take it back. We will talk about Norway later on in another context. Yes, Norway in the next lecture. Somebody is another way. So each method that I've given you here will help companies reduce legally their taxes. So where am I going to go? The company, wherever I get the biggest benefit. Not because it has all the oil in the world. They have all the oil in the world. I'm not going, because if they take everything in taxes, why would I go there? So obviously policy is a question here. Remember I said part 3 would be a policy-related question? So having said that, I'm looking at the watch and I'm saying to myself, I've pushed you enough. And now it's a very important policy question. Where would you go? I'll compare countries which offer this versus that, and how do they do it? Indonesia comes to mind. And with that, I'll rather start fresh. It's going to be a little lengthy lecture, and compare tax regime system of Indonesia and the United States and say, where are you going to go? For that, you need to be fresh and have a little more time, a little more comfort level. Now it's good over 2 hours. And this is nonstop, of course. So we'll catch you next time. Okay. Have a good it's a weekend then, enjoy your weekend. I'll catch you next time. Thank you and bye-bye.